Is it finally over? That's the question surely on the minds of traders today after stocks follow last week's positive lead with another rip. We're going to break down what is going on here and whether the spook that has played out in markets since the latter part of February, call it mid-February, for 4 weeks of dramatic losses, is in fact over. Certainly, it seems like the markets are trying to find a way to say that, or if in fact there is just a reprieve here that's temporary before more pain is on the menu. That's what we're going to see if we can't divine here as we look at first why last week was what it was, and also why we might have a situation here where the path forward isn't as readily constructive as this price action might seem. So let's first and foremost look at the brass tacks here and review the performance. So clearly, the story is one that sort of writes itself. Stocks higher, yields lower. Needless to say, even if you didn't know anything at all, you might look at this and say, well, what happened last week? What was the one big macro catalyst? Oh, there was a Fed meeting. Well, okay, stocks higher, yields lower. That means the Fed was dovish. And indeed, it seems like, as we talked about on Friday, the message from the Fed was, at the very least, sufficient for the markets to feel seen. There was a level of concern that there was a downturn in the economy, or at least the perception of one, as survey data, which of course is always early in these types of transitions, started to scream out, be it business confidence or consumer confidence, that something is going wrong, and the markets became spooked when the administration in Washington, D.C. said, we're not really concerned with this. The focus shifted to the Fed to say, well, if fiscal policy isn't going to bail us out, maybe monetary policy will. And so there was a desire for the Fed to come in and say something encouraging to the tune of, yes, markets, we too see that the survey data has turned south. We too are concerned, but we don't need to pull the ripcord at the moment. There is no need for any kind of an emergency. We can wait and see. But rest assured, if this survey data starts to transition into hard data, like, let's call it inflation or employment, well, then we're going to be beckoned to act, and there's nothing that's going to tell us otherwise. We're here to fend off threats to our mandates from wherever they may come. And so with that, the market seemed to have become reassured. And so stocks rebound after those heavy-duty losses in the prior week that capped the 4-week sell-off. Yields have a significant move lower, so bonds come up, and your sort of usual suspects cyclically respond here. Crude oil higher, 1.6%. That would make sense if the growth scare has abated a bit. Gold up, albeit less than before, giving it a sense that maybe gold was front-running this. It's up 0.7% after the 3% rally in the prior week. And interestingly, the U.S. dollar comes up a little bit stronger against the euro, which comes in 0.6%, a little bit stronger against the yen, which comes in 0.5%. And so when you sort of look at gold and the currency markets, you get the sense that maybe they were early to the idea that the Fed would say what they said, and stocks and bonds just needed to wait and get the confirmation. But perhaps gold and the dollar were already on this kind of time before the announcement, because it seems more like they had their moves earlier, and with the Fed signaling to the market's pleasure, they took the opportunity to see some of that speculative interest get unwound and portfolios to get rebalanced. So all of this seemingly makes good sense in the context of what we saw. And of course, now we get a little bit of confirmation as the week begins, because here was the Fed's new updated summary of economic projections. Obviously, there was some shifting around of growth and inflation expectations, higher inflation expected, lower growth. And the way that Chair Powell explained this was, this is the thing that we would expect tariffs to do. We don't know what these tariffs will do, but historically, more trade barriers mean usually slower growth, higher inflation, all of which makes sense, just very baseline. If you get an increase in prices, people have incrementally less money to spend. Most of the economy is consumption. So if you tell people they have less discretionary income to spend because they're spending more on their typical basket of things because some of those things are imported and now they cost more, then there's less economic activity. Economic growth slows. So you get higher inflation because of the adjustment in prices, and you get slower growth because of the crowding out of discretionary spending by that rise. So not exactly rocket science. But the Fed was very clear that they don't know how these particular tariffs are going to work, whether the price adjustment will be a one-off after which things normalize, where people switch their consumption basket to things that weren't tariff impacted to the extent possible, and things level back out. So they don't know, and because of that, the upshot on the rates path is unchanged. 50 basis points on the menu for this year, from 4.4 to 3.9, and 50 for next year, from 3.9 to 3.4. We get the PMI data at the start of this week, and it gives us a bit of a growth bounce as the service sector finds legs for a rebound. We can see here meaningful pickup in economic activity growth in services, 54.3 versus standstill expected, 50.8. That's just a hair above this 50 boom bust level. Above it is growth. Below it is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We can see here manufacturing slipped back into contraction territory narrowly, still pretty close to standstill, but narrowly under 50, and so in contraction territory by a hair, but certainly much worse than expected. Perhaps the front running of tariffs that was so loudly discussed in the PMI numbers, explaining this upswing in manufacturing toward the end of last year and into the beginning of this one. Perhaps it's finally run its course. But what we see most importantly is services, which you can see is the main driver because the composite index is pacing that and very much not the manufacturing side. Services is a much bigger component of the overall economy. You see that with the rebound in services, you also get a rebound in growth. Not quite back to where we were last year, but seemingly improving and arresting certainly this decline. And that seems to endorse the idea that there is no emergency, that essentially things are cooling. Clearly, this was steady growth, and this, even with the bounce, is now something of a cool-off. But nothing is catastrophic and nothing is falling off a cliff. And so when you look at what that has done to Fed policy expectations, we see that the markets and the Fed are now almost in alignment. Market has 58 basis points in cuts this year, 43 next year. So we're very, very close to being in line with the Fed's outlook of 2 cuts this year, 2 cuts next year. We're almost there this year, almost there next year. there's a slight bias in the markets toward more easing sooner. That's how you get 58 and 43. And of course, there's some rounding there. But that's how you get there. And that's how the total ends up being essentially 4 cuts over this year and next, which is exactly what the Fed has in mind. So this perhaps starts to explain why gold and the dollar are anchored, because we essentially have squeezed out all of the speculative juice out of the Fed story for the moment. The market and the official projections are a few basis points here, a few basis points there in line. And there's not a whole lot of juice. And now then the question becomes, what comes next? If what we're seeing in the performance here is that stocks are up, not necessarily because you have a forward-looking expectation of a more dovish Fed, but because you've realigned to what apparently the currency and metals market already knew. You've caught up here. You've had a one-off adjustment, as it were, in sentiment, and now you're basically looking on the other side. There is no crisis. Growth fears are present, but not an imminent hair-on-fire kind of risk. Well, then the natural next question is, what's going to be the catalyst that takes you in a different direction? And this week, that is a slim offering. In fact, it remains a slim offering until you get into the U.S. jobs report at the end of next week. On the menu for this week is U.S. PCE inflation data, the expectation that you are going to get 2.5% on the headline inflation number. This is, of course, the Fed's favored inflation gauge. That would make it unchanged from the prior month. And looking at the core reading, which is really where the Fed's interest mostly lies, because needless to say, they don't have any agency over global energy and food prices. And in any case, we can very clearly see here that core services is where most inflation still remains at this point. There's a fairly steady wedge for housing, but this is really the business cycle right here. There you are expecting to see 2.7%, which would be a wiggle higher from 2.6% in January, but still below the 2.9% in December. So you'd essentially be going back to September of last year. Not exactly striking numbers. And in any case, the PCE numbers tend to be very well forecasted by the markets. Once CPI and the PPI index, consumer and wholesale inflation, once those are out, their components can be reconstructed into what goes into PCE, and the markets tend to be relatively good at getting these forecasts close to right. Rarely is there a sudden surprise. So this is probably not the indicator that gets the markets meaningfully spooked, but it could be a waypoint whereby after it, the markets feel freer to do whatever they were going to do. For what it's worth, U.S. economic data has somewhat anchored relative to expectations with a slight bias toward disappointment. We're below the zero line here, so it looks like at this stage, the market still tends to favor outcomes that are rosier than what reality actually delivers. And so there's a slight bias toward disappointment, but because PCE doesn't tend to surprise much, and we are effectively now in something of an equilibrium between market expectations and the Fed, it doesn't look like we're going to get very far on this cumulative easing path this week. Unless, of course, something comes out of left field, as it always might. And so with that in mind, you might have more room for stocks to head higher, just because there is not an obvious reason for them not to. There's not a macro catalyst to fear, and there is apparently a favorable reading of what the Fed has suggested. We'll see if the story in bonds becomes anything other than relative standstill after this adjustment. The sense in gold and in the dollar, as we just said, seems to imply that the markets already had a bias going into the Fed, and that bias has mostly held, and so there's not been an impetus for change. So perhaps bonds are anchored here alongside these considerations, while stocks have room to drift higher just because their obvious headwinds have resolved until more data risk is on the menu. Meanwhile, outside of the U.S., more inflation data is due. We, of course, didn't just have the Fed last week. We also had the Bank of England meeting, which struck a little bit more of a hawkish tone. We are going to get CPI numbers out of the UK this week. The expectation for a bit of a pullback down to 3.6% on core, 2.9% on headline. And the key thing here, as was the case going into the Bank of England policy announcement last week, of course, was that inflation is stuck in a strange area. The really significant bits here that are sticky and refuse to give way are recreation and hospitality, which is a bit odd considering the UK economy over the recent months has been weaker, not stronger. And you'd think that what that would do is hurt those pockets of demand that are more dependent on discretionary spending, as recreation and hospitality would be. But clearly that's not the case here. Moreover, we've just seen here that the UK's version of PMIs, we got both the US and the UK numbers today, as well as some others. For the month of March, there's been a little bit of an upturn here. So just as there's been an upturn in the service sector in the US, so too in the UK, and so too this is the main pace setter for the overall economy. Now, the situation in manufacturing in the UK, absolutely abysmal, a very steep pace of contraction in March, going all the way back to the middle of 2023 for a reference point there. But the overall economy, powered by services, pointing higher. And the outlook on policy seemingly near the hawkish end of the range. Now, of course, there's still rate cuts that are called for here. So at level assessment, this is a dovish central bank. But we can see here we've basically been oscillating between around 45 basis points in cuts over this year and next, and 70 in a kind of range since the beginning of this year. And we're near the top of this range at 51 basis points. So it looks like we're biased to perhaps 2 cuts this year and then next to nothing next year as a sort of path of least resistance. And after last week, the Bank of England voting pattern ended up a little bit more hawkish than expected. Fewer votes for cutting or for holding last week than anticipated, and the bias in the rhetoric seemingly suggesting, look, there's a lot of uncertainty. We don't want to cut into what could be an inflationary global trade dynamic. And of course, with this stickiness right here, the Bank of England is hardly in a place to do much cutting, beyond what's already there, of course, considering that stickiness follows after this prolonged slowdown in activity. Perhaps it's the rigidity of labor markets that explains why. But when we consider what comes next, even if these numbers edge lower, It seems like the Bank of England doesn't have a whole lot more cutting that can get priced into the outlook. Moreover, if this PMI dynamic is to follow, then there's a little bit of upward pressure on service sector demand, which we can see clearly is what is the main fuel here. So you might actually end up with then an upside surprise on the CPI. We'll see what this does, because, of course, for the moment, the dollar has been mainly a creature of its own accord against other currencies. So the pound has been mainly pulled around by U.S. yields in its relationship with the greenback. And this extends to most currencies, save for maybe the euro, which has had the outsized rally because of a pickup expected in European defense spending around backstopping NATO. So we have a situation here where the pound, if it gets this kind of confirmation of standstill at best at the BOE, continues to track broadly with U.S. yields and the dollar, and to the extent that they're static, it'll be interesting to see where the balance of power shifts, making the pound almost a canary in the coal mine for the dollar this week. If the pound manages to rally, that might suggest that an independent lead is once again emerging for the dollar against other currencies. Maybe give us the beginnings of the next leg of dollar weakness as a tradable idea. But if the market ultimately sees standstill on both sides of the Atlantic and opts to punt, then we might have to wait until the next big splash headline out of Washington, D.C., or next week's big macro data to put a lid back on stocks and inject some more interest in other, more two-way markets. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise on with Chris for Futures Power Hour, Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for watching. If you're seeing this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.